Good morning. Welcome to SOXX Insights. Today is October 17th, Friday, just before the market open. Everything seems to be selling off today. SPY is poised to open at down 1%. And the issue seems to be some loan frauds that's been discovered in the regional banks that could signal a much wider spread concern among the regional banking sector. And we have seen some banking stocks selling off. And back in 2023, we had an episode of the Silicon Valley Bank and also a number of other regional banks going bankrupt thanks to rising interest rates and the losses on the balance sheet. So this episode does make people feel concerned. This could be a repeat of the regional banking crisis. But as you recall from last time, the Fed stepped in and set up the bank term funding program and injected liquidity into the banking sector. So I think this episode, alongside what we see in rising unemployment rates, could prompt the Fed becoming a bit more aggressive in its dovish stance in the coming month. A number of the Fed officials have said that they are looking to cut rates more. And I think that's just the beginning. We're going to end QT formally very soon and potentially starting QE again, even though no one mentions that just yet. Looking at the credit risk, so we've been following this proxy, which is the high yield credit ETF versus the IEF, which is a US Treasury ETF. So this ratio going up signals there is a growing investor risk appetite for high credit returns versus parking money in a more risk-free instrument like IEF. So as we've seen since August, this ratio has gone sideways but with a downward tilt, and actually now we're reaching new lows versus the summer. And that signals to me that investors are getting a bit more concerned, not just about the credit risk, but their risk appetite is reducing, even though the equities are still 2-3% off the all-time highs. So this is an advanced signal of things could be deteriorating. And if you just look back where we were in February, this ratio moved down first before the stock market crashed. And again, if you look at July last year, the carry trade unwind, this proxy went down significantly as the market fell. So this is definitely something we have on our radar all the time to make sure we are dodging any big crashes that's coming. Secondly, the thing I'm looking at is the credit spreads themselves. We use the data from Fred, and we see that. So at the top is the investment grade bond spread changes week over week. So the red lines are 2 standard deviation from the mean, and the green lines are the mean. So at the moment, it's gone up a little bit this week, but we're not in the crisis territory yet. And again, for the high yield, actually, this measure was much higher early in the week, something like 20 basis points, but it moved down in the past couple of days. So we're not quite at the 2 standard deviation crisis mode yet, but if we do approach this, so I monitor this almost every day now, and if we get to, let's say, the July levels or even the April levels last year, and also the late and the March level in 2025 this year, I think it's really the time to be cautious about risk assets holdings across equities and even crypto maybe. So we're not quite there yet, but the fact that we have 3 consecutive weeks of rising credit spreads is a little bit concerning. So we saw that at the end of last year in December, and the equity market did fall off a little bit. Instead of the Santa Claus rally, we actually had a sell-off period in the second half of December. And again, in February this year, we also saw this increase in the credit spread. So again, that is a forewarning of risk appetite reducing, investor demanding for high yields for high risk assets like high yield credit, and they might shy away from chasing equities and instead parking more bonds. So looking at the S&P 500 year-to-date returns using the SPY ETF, So year to date, before the market opened today, we closed 13.7%, which is still a very good, strong return for this time by this stage of the year. So today we're going to have a stronger sell-off, which could take it to 13% or even 12.5%, depending on the extent. But all in all, that it would put us in the median year of the past decade. So it's not the best, but it's also not that bad either, especially considering we had a round trip almost touching the bear market territory earlier in the year. And I think the important chart to look at is this next one. Going into this month, we actually expected a pullback this month because of the seasonality month. Just looking at the historical monthly returns of what happened in the past. If you look at the past 20-year history, we enjoyed a 5-month consecutive up month in 2025 so far until October. And if you look at the past instances that this had happened, 2016, 2017, 2018, and 2024, 3 out of the 4 occasions, we saw negative returns in October. And it's not really a seasonality thing. It's more about investor momentum exhaustion and needing a pullback to digest this gain, which is quite unusual to have a 5-month stretch, especially if every single month of this 5-month stretch this year has been more than 2%, which is not something you saw even on in the previous occasions. We had some sub 1% gains in 2016 to 2018 periods, and even in 2024 we didn't get the 2% plus in every single month. It was a 1% return in July. So this year has been exceptionally big going into October. So for me, a pullback is pretty natural here. So it's so far nothing to extremely worry about just yet. And then looking at November, if you notice, if you look across the month after the October in those periods, November has always been very bullish. So 2024 up 6% and then up 3% in 2016 and 17. Just looking across the board, we only had one negative return in the past 10 years, potentially past 15 years. And the last time we had really negative November was 2018 financial crisis, but already the market was in turmoil going into November. So a correction in October followed by a sizable bounce and a potentially new high in November is, I think, the default expectation for now. And then now looking at the size of the rally we've enjoyed from the 52-week low, we have reached the point where we have run up more than 30%, almost 40% from the 52-week low. And historically, when we get to this point, we tend to have a bit mean reversion pullback. So this is a resistance area above the 30% run up. And again, looking at the number of days, percentage of days at all-time highs in the past 1 year, we're hitting this 20% mark, which typically is a resistance area. So we tend to see pullbacks once we hit the 20% all-time high. So I'm not really that surprised that we are going to see some retrace at those levels. Looking at our trend versus volatility regime. So this chart is very simple for those who are new. Top chart, we divide the regime into 4 quadrants. It's either bullish or bearish, depending on where the stock is relative to 50-day moving average. So above 50-day is bullish. Below 50-day, we say is bearish. And we'll look at the volatility. So if the volatility is above 1 standard deviation from its mean, it is something we need to be very cautious about. So it's a volatile state. And below 1 standard deviation, when we say it's a calm state. So mostly since May, SPY has been in a bullish calm state. That could change today depending on whether the 50-day moving average holds. But even if it breaches the 50-day moving average, our volatility is still pretty benign. We're just around the historical averages. So again, we haven't seen that sharp spike you would normally see in the crisis zone. And I think when we cross this one standard deviation, or maybe just when it starts crossing the mean first, we start raising a flag. And then when we cross the one standard deviation, we're thinking maybe time to stay away, unless it's a good volatility, which means if you look at AMD chart, it's going parabolic and volatile, but it's volatile because it's going upwards really fast rather than downwards. Now, looking at the weekday returns, Fridays tend to be a day where we have a lot of tail risk, where we see negative returns bigger than 1% most often. And that is because of a few things. So non-farm payrolls are published on Friday, and that is a volatility driver. And we saw in September, the non-farm payroll number drove down a big sell-off on the day. And secondly, Trump likes to announce stuff on Friday, tariff-related news. And I think that is tactical because they can announce it on Friday. Okay, the market sells off. And then over the weekend, they get all the governments to start panicking about the tariffs and drive them to the negotiation table ahead of the Monday open and before Monday. So Sunday afternoons, the White House can announce something constructive for the coming week. So we see these big swings between Friday sell-off and then you see Monday rallies above 1% most often as well because of this dynamic. Again, today we are expecting a sell-off. So again, that puts another dot here on this bottom right for Friday negative returns. And finally, just touching on Bitcoin, and we're seeing crypto under a lot of pressure after the deleveraging we saw last Friday. So last Friday, Trump announced potential tariffs on China due to the export controls around the rare earth, and all risk assets sold off. And that triggered a huge deleveraging event in crypto, $16 billion worth of position, potentially more, because exchanges tend to underreport a little bit on the true sizes of the losses. So they don't try to panic the investors as much. But historical size of deleveraging occurred last Friday, and all the crypto assets rolled over. We had a bounce on Sunday and into this week. But I think the damage was too great and the confidence and the momentum is still a bit low this week. So we're still seeing a lot of volatility in sell-off now. However, if you look at where Bitcoin trades relative to gold, because they're both subject to the same global liquidity pressure, but with a 60-day difference in terms of lag, gold leads Bitcoin by 60 days. And you can see that the directional movements tend to be very similar 60 days apart. We see that potentially Bitcoin and the rest of the crypto market could pick itself up towards the end of the month, like gold did back in end of July and August. And we can see a very strong rally into November and into December. And late October, November are historically bullish periods for Bitcoin, where you see the biggest gains over the year. Now onto the live chart analysis. I've had this ABC expectation since the crash on Friday last week. And we moved higher, and I did think that was a B wave and into this trend line. And it didn't quite hold above it. And now I think we're moving in this wave C of wave 4, and that could end around 640. And just zooming out slightly to see where this trend line comes from, this is a trend line we've had since late May. It's been tested about 5 times, I would say, and the market held above it, at least close above it each time until last Friday. And now this support has become resistance, which is very classic because a lot of people would buy at this area and then it fell through, and now they're looking to offload at break even when it touches up. And now we're seeing 640 as a potential downside target. However, we do have 50-day moving average in blue as the first line of support. And I feel fairly confident that we have 640 as a reasonable target, given the size of volume we have here as well in this region. So I do think there will be a lot of dip buyers coming in here in this region to pick up share. And I think they will eye for the next wave higher, which will be a new all-time high, potentially before the year end for wave 5. Again, for QQQ, it's been traveling in an upward channel, mostly in the upper half of the channel, but recently fallen below, and is supported by the 50-day moving average as well. But I do think this rally here this week was a wave B bounce, which means we have one more low to come, and that could land us around 570. There is sizable volume over here. There's a big volume profile in this level, so I feel fairly confident that we will see a lot of buy interest in this region again, and that should support going to the next leg higher. Looking at the 30-year bond yield, we've been tracking this every single day, and it has moved very much in line with my expectations since September onwards. And it fell through this 200-day moving average back in September, the non-farm payroll day, and that has become a big resistance area for the 30-day yield. And we had this expectation for wave 5 at 4.5%. Today, we're trading at 4.58%, so very close. And it actually even touched the upper side of my target region. I think we could complete at 4.5 in the coming weeks. And then potentially we get another bounce for this wave 4, large degree wave 4 higher. But it's unlikely to break above 5% in this cycle. So TLT, you can think of TLT as a near mirror image of the 30-year yield. The TLT is ultra long-term 20 to 30-year yield. And we have been tracking this for this wave 5, which I do think can get to 92. And we've been saying this since this breakout at 88. So this has played very much perfectly to our wave counts. And now I think we're in the end game for this large degree wave 3 before the next retrace. So I still see it going higher towards 92 in the near term. Oil, we have for a long time been very cautious that it was moving in a sideways pattern with a bearish tilt. The 70 to 72 region was a strong support here, which did break down last week. And we're seeing oil decisively moving lower this week into our target region of 66 and potentially below for this wave 3. So this movement has been pretty much spot on in relation to our wave count. And after we reach 65, 66, potentially even getting a bit lower than that, we can see a bounce back towards 70. And I think if you could just see this support region here, you can see that that will become a resistance region as well for this wave 4 bounce. So Bitcoin, since our last video update, the sell-off has invalidated our initial bullish structure for wave 5, and instead I've turned a bit more cautious for this wave C. So we actually mapped out this potential 5-wave move after the Friday sell-off, and it has played to this expectation. If you are subscribing to my daily newsletter, you will see that. So now this wave 5 is actually on target to what I would expect for a normal wave 5 of C. And this region of wave C is also where I would expect relative A, which is in an expanded flat. So I think it could stretch all the way down to 100K. I wouldn't be that surprised if it does, but going below 100K would be me thinking, okay, maybe this structure is a bit even more too bullish for what's happening, and we could be in a much bigger pullback here. So I would say holding above 100 is still my expectation for wave C of this wave 4 as the bottoming region. Below 100, we have to reassess the structure for more bearish outlook. And I do still think that wave 5 is in play, and that wave 5 can go above 130 quite easily, but even potentially 140 relative to, and it depends on where wave 4 really finishes. So Ether's structure is slightly different to Bitcoin because this wave B high didn't actually break above the wave 3 high. So this is actually just a fairly normal flat where I would expect wave C to be around 100 to 120% extension of this wave A. And we did reach that in one go on Friday, but that was more of an intraday sell-off. We could retest this 3,500 region again today over the weekend to complete this wave C. And I think coming to this 3,300 area, there's a big volume profile as a major support. If we fall below 3,300, again, I would have to re-examine the structure. We could be in something much more bearish, but my expectation is for it to hold above this 3,350 region and potentially looking at wave 5 rally into November. Solana, I just want to give you the big picture view again. A wave 3 rally here in September never breached the all-time high in January. So that itself shows relatively weak relative strength to Bitcoin and Ether. And potentially we're in a leading diagonal where this wave 4 pullback overlaps wave 1 high. And there's also a more bearish interpretation, which is this is an ABC wave, because this wave 3 really never extended much beyond the size of this wave A. And that implies a much more bearish outlook for Solana. But that's not my primary expectation just yet. I still think we are in a leading diagonal wave 4 pullback. It's been supported by the 200-day moving average, but in truth, it could pull back even further below 165. I wouldn't be too surprised by that. And if we just zoom in a little bit on the 3-wave structure for this wave 4, we can see that we are around the typical termination zone for this wave C versus wave A. So I do think the sell-off, even if it gets a little bit steeper, is still buyable at the moment. But I would get really cautious if it gets below 160. So that's where I would have my stop. Coming on to Coinbase. So this is a pattern I've picked up for Coinbase in the near term. The August to October price action this year looks scarily similar to the September to November price action of 2024. So we had a rally pullback, another rally through this red cloud, and then touching down pullback at the bottom of this red cloud. Again, we've had a rally and pullback, a breakthrough, and then now today we're going to touch down the bottom of this cloud here. And last year, this period coincided with the US election, and we had a 100% rally from the bottom of this cloud to the top in December. This year, I probably wouldn't expect a 100% rally, but I do think this region is potentially a very buyable region now, looking at the November towards the year-end rally again. And just looking at my expectation here, I do think this was a wave 3, and we had a wave 4 bottom just above the 200-day moving average. We've moved past the 50-day moving average, a retest, and I actually think instead of this being the wave 1 and wave 2, this is a 3-wave wave 1, which you would see in an ending diagonal. And we have a pullback in this wave 2 here today, and we will see a 5-wave finish for this high degree wave 5, with the exception that potentially this wave 3 is not as high as you would expect in an impulsive wave where we have a more reaching the 100 or 123 extension of this wave 1 in the 3-wave faction as well. So we see 1, 2, 3 ABC and 1, 2, 3 move down, and then potentially 1, 2, 3 move in this wave 3. and for the rest of the wave 4s and 5s. So that is my expectation today. So I do think Coinbase looks favorable for another rally, especially post earnings. And the problem with Coinbase on the fundamental side is that we had exceptional growth period last year. So the financial periods report this year are reporting against a very high bar from the previous year. So because of the lapping effect, so the growth this year looks more like 10%, 20%-ish versus 100% growth in the year before. So that's why Coinbase has plateaued with a lot of volatility in the past year. If we look at where we are now, we're actually trading at a similar high level in 2024, meaning that Coinbase share price hasn't appreciated in almost a year. And with the big volatility upside down, which is great for trading, the price growth actually reflects the fact that Coinbase is overlapping a very high growth period in the year before, and the fundamentals are slowing a little bit. But in terms of the technical levels, I do think we should see one more high in this wave 5 that could take us into the 500s. Potentially, the upcoming quarter reporting will be quite key, especially looking at the custodian fees, the subscription fees that Coinbase is generating. And given the big surges in price for Bitcoin and Ethereum in the July, August, September quarter, we could see a burst in trading fees as well. Robinhood, I do think this is a potentially wave 4 pullback, which is still holding above this wave 1 retrace. And this looks like a 5-wave impulse run. And I do think we have the potential to get one more high here into the 160s and even 170s here. Could it touch the 50-day moving average? I think that could. If it does, we could lower our expectation for wave 5. So this becomes more of an ending diagonal structure. For gold, I think it's almost pointless to do much technical analysis on this. This is a parabolic run that is just a chart wonder. It signals the late stage rally where retail is even piling in after the institutional investors and the central banks earlier in the year. I saw the news that people were actually queuing outside the bullion shops in the morning, waiting for it to open so they can get their gold share. So when that is what's happening, I always get very cautious, at least for a pullback. But while it's happening, it could just seem to stretch forever and get people to FOMO in. But I would get very cautious at these levels. Apple hit our target for wave 3, and now we are trading downwards for wave 4. And I do think this is not yet complete. We can see a bounce, which will be a wave B bounce here. And I think we'll test lower low below 240, potentially below this 50-day moving average. But then after that, I do think we'll have a wave 5 high in the coming quarter. And the reason I'm also bullish on Apple, if you look at the lead days for shipping of Apple's iPhone 17 versus iPhone 16 this time last year, there's been there are signs of a larger demand shipping periods, especially in the international markets outside the US. In China, the government is giving subsidies for smartphones. So some of Apple's models could actually qualify for the subsidy, for the discount on the cheaper end. And I do think going into the festival period, winter shopping period, we could actually see more news coming out saying there's momentum in the iPhone 17 product suite in terms of sales this year, and potentially higher growth rate versus the last year. So I think that could be a tailwind on the fundamental side in this product cycle that should drive us with a new all-time high, just under 300 or even 300. And if you look at what we had last year, we saw that seasonal rally at the end of October into December. And investors could be looking at Apple again for a bullish bet. So looking at Amazon, I do think this wave 5 is by and large complete. It's holding just above the 200-day moving average, and this fall has slowed in the past week. The lows have been touching the same region every single day in the past 3 days, and this completes a 5-wave down for this wave C. So just looking at where we could get to for wave 5, I think wave 5 typically is the 138 extension or plus of the inverse extension of this wave 4. So that could put us to the 250, even the 260 region for this wave 5. I do think going to earnings, that the very important thing is to see a growth number that is better than before in the AWS. So a criticism Amazon has had is that it drives the majority of the valuation for Amazon, but it's growing at a slower rate. So it's versus we have in Azure and Google Cloud. So yes, these are smaller platforms relative to the size of AWS, but those platforms have seen accelerated revenue, whereas AWS has plateaued. So investors really want to see an acceleration of revenue from AWS this quarter. So Google has made a new high or just matched it. So I do think that could complete this wave 4, which is pretty shallow in my book. But if you look at this trend line here, this was, again, the resistance trend line from April onwards. And after Google's court case was over, we had a jump in the price and then a retest of this trend line, and now it's moving higher again. So if this has started, we could look at wave 5 here, potentially going towards 290, 300. And I'll have this wave 5 as potentially the same size as this wave 1 here. So there's also a quite common length of wave 5 extension from the wave 4 low. Meta, so our model has been correctly risk off for more than 2 weeks now. And Meta is in this bottoming region here, which from a technical level has completed wave C relative to this wave A. And it's standing right at the VWAP, so the volume weighted average price since the April low. So this price has been a very strong supportive region for Meta in the past 2 weeks. What I want to see is now moving back towards the wave, towards the 50-day moving average and breaking above it. If you are impatient, you just want to buy in the bottom, I don't think this is a bad area to buy. I think this is looking at quite attractive region, both in terms of valuation, in terms of correction we've had from this wave 3 high, and we could be looking at 840 onwards for the next wave 5. But it's understandable that if you want to have more evidence confirming the potential move next, especially in this environment, it just means better risk but lower reward. Microsoft, I do think this rally was corrective. We've had ABC rally, which topped for wave B here, and C is around the same length as wave A. And now we could be moving towards the wave C low. And that could be a new low regionally into the 470 or potentially 460 area to complete this wave 4. So just above the 200-day moving average. But if you look at where we came from, we had a strong set of earnings and then gap up and big money buying clips each day in a very controlled manner, where the daily moves doesn't exceed 0.5% and moving all the way here. And then the trades finished right before the earnings. We had a big earnings pop, growth acceleration, etc. And then actually the stock starts selling off. So you can see that this is work of big money going in a daily manner, and then stopping and finishing the biz right before the earnings. And now the stock is just digesting some of these gains from the spring, early summer period. Looking at NVDA, I do think we are in wave 5 because of the size of this wave 3, relative to this wave 1, but also relative to where we had in the previous high. And there is a lot of volume supporting here in this region, which signals a lot of buying interest with the 50-day moving average here. So I think overall we are in a uptrend, and we could be challenging 200 in the near term. But of course, with today's sell-off, NVDA is still going to get some of that, and it could take a little time for this rally to renew itself. But overall, I still remain bullish for NVIDIA. And one thing so I covered an episode of NVIDIA's asset price behavior in the past, where the real challenge is actually going into the November earnings. The volatility really starts to pick up around this time, late October, November. And that's probably when we can see going towards the earnings, we can get that rally again. Whereas after the earnings, the volatility dies down, and I think the stock could actually even pull back going to December afterwards. Tesla, I flagged that Tesla could be having a pullback when it was around 440, 450. So truth to be told, the pullback hasn't been that steep. I think we tested the 400 in the aftermarket, but never during the market hours. Still, this is a period of sideways action where I do think we've had a dip initially and then wave B rally. And now we should be looking at wave C just below 400 to complete this entire pullback. And this coincides with the global liquidity lag, again, very similar to Bitcoin, where we're in a more challenging period. So we've seen the stock actually moving sideways for almost a month now. But overall, we are in a larger degree uptrend where we see this wave 1 and wave 2 still having a lot of doubt and uncertainty in this period. And people were wearing out. They were getting impatient in this narrow range here. And then we saw a big move upwards with Elon, after Elon's comp plan and him personally buying some stocks. And now we're having an earnings season coming up next week. So I suspect we could finish this wave C just before the earnings, and we can get a big post-earnings pop. And the earnings narrative is actually very, very clear. We had a strong delivery number in Q3. And it's not just that, which is already priced in. It's the fact that Elon will really emphasize on the fact that with the set of delivery numbers, people can really see how FSD works. And all of those cars are potentially new robo-taxis on the road in the future where people can participate and leasing them out. And previously, Elon said by the end of the year, he expects half of the US cities to get access to robo-taxi. He's going to give some more update on that. So I think the Q3 delivery numbers coupled with the robo-taxi potential is really the secret sauce for the next move. It's just really getting investors to see that potential of millions of robo-taxis on the road simultaneously overnight, rather than just churning out car production numbers quarter by quarter like any other car company. PLTR, we've had sideways actions for a month now. We still haven't broken above this wave 3 high, which is quite annoying. But overall, this bounce here does look like an impulsive pattern here where we have a 5-wave move, which should end somewhere above 200, which will be a new all-time high. And I think that really would mark the end of this entire bull cycle. SOXX just been very bullish in the recent rally. So we're back to the all-time highs again. To me, this is not end of wave 4. So I'm still expecting a slightly deeper pullback. But right now, this rally has been going much stronger than I had expected. So we just have to wait and see how it resolves. Whether this wave 3 just keeps on going or we start to see a new low, then we can start confirming this wave 4 pullback is really happening. So that's it for this week. Thank you for joining me this week. I'll see you again next week.